Hello everyone, my name is Alvis and welcome to my channel. God, talking to a camera is just so weird. Anyway, the stock I want to talk about today is Chargepoint. I cover the fundamentals, do some technical analysis and share my price targets. Now, none of this is financial advice and these are just my thoughts and research. Now, if you're someone that's familiar with the company and just want the price targets, I'm going to leave a link in the description below so you can just head there. Otherwise, if not, let's dive into the video and just see how much potential, in my opinion, this stock has. One of the reasons I'm bullish on Chargepoint is because it's in the EV market. According to Bloomberg, EV sales rose by 94% in just the last year. And I think it's just going to continue to grow. All of those EVs are going to need charging stations, and I think Chargepoint is going to be one of those companies that will benefit from the EV boom. So what does Chargepoint do? To put it simply, they manufacture and sell charging hardware as well as charge for charging subscriptions after that hardware has been installed, or if you're just charging at a supermarket or something like that. The really good thing about the company is that their aim is to provide charging solutions to all sorts of vehicles. We can see here that they want to be the go-to point for passenger cars, delivery vehicles, buses, and pretty much any EV out there. They state that to this day, they can charge any EV model out there, which is really good because that probably means that it's going to remain that way, even as car manufacturers scale their product range. So I got all of this from their website. If you want to learn more about the company, you can do that on their website, which is chargepoint.com. One of the reasons I'm really interested in this company is because of their 2021 Q3 earnings. We can see here that their quarterly revenue increased 79% year over year. Those are amazing numbers. There's not a lot of companies that can achieve growth like that. And they've also raised their revenue guidance, which means they're doing pretty well and they're expecting to do the same in the future. The company said that demand for our solutions in Q3 continued to outstrip our expectations and production ramp. That's actually really bullish, as there's demand that they're struggling to meet, which means that they have the opportunity to invest and take that market share, which would be really good in the long term for the company. Let's have a look at their earnings now. So all of these numbers are in thousands, so that's 65 million, 49 million, 16 million. I've put the revenue, cost of revenue and profits in a chart as I find it easier to see what's happening with their earnings. So we can see that their quarter over quarter revenue is increasing, but is that just due to them spending more? The profits are getting bigger, but as long as their cost of revenue keeps increasing as fast as their actual revenue, we probably won't see any profitability like anytime soon. On the other hand, if we look at their profit margins, they are going up quarter over quarter. So if they can keep this up, their balance sheet is actually going to start looking a lot better. But we'll go into that in more detail in a second. To get a better picture on their revenues, we need to have a look at their revenue sources. If you're wondering where I got this is from their third quarter earnings release reports. So let's have a look at their revenue. They report revenue along three lines: network charging systems, subscriptions, and other. This other isn't really significant. It doesn't even come up on the financials properly. Anyway, so network charging systems represent our hardware, all sold with our cloud services solutions. Subscriptions include those cloud services, so it's pretty much that. Our assure warranties, our Chargepoint as a service offerings, where we bundle our solutions into recurring subscriptions. So basically, you buy the hardware, they install it, let's say, in your house or on the street or in a supermarket's car park, and then as you charge, you're in their subscription and you pay them monthly or whatever it is. So in the last quarter, their revenue was 65 million, as we can see over here. 48 million was from network charging systems, and then 13 million was from subscription revenue. That's why I said the other doesn't really matter. So in the long term, we really want to see the subscription revenue go up, because once you install a charger, you're not going to get another one. Well, maybe you will, but most people won't for a very long time. I don't really know how long it takes for them to break or whatever, or need replacing for whatever reason. Anyway, if we read all of this, there's basically a time lag of at least a quarter from when you install the hardware and then you get your subscription revenue. So we have to keep that in mind when looking at their revenues, and maybe that's why their revenues aren't actually growing as as fast as we'd probably like to see. But if you think about it, as they deploy more charging stations and all of those subscription revenues start coming in, we should start seeing their profits go up. Because even if they're still spending a lot on new charging stations and stuff like that, their subscription revenue is going to come in, and then their gross profits are going to start going up. But it's just going to take a while. Another thing in terms of their profit margins, so over here they say that the supply chain constraints cost them 2% in their profit margin, so it was supposed to be 27%. So the cost of revenue would have actually probably been lower, maybe even lower than the previous quarter, which is really good. So let's have a look at their cash on hand. Right now they've got 365 million left. That's a big drop from 618 million compared to the last quarter, but that was due to an acquisition they made that cost them 210 million. So as we can see here, obviously they're burning more and more quarter over quarter, but 365 million is still quite a bit for this company. So if we estimate that they'll be burning roughly 65 to 70 million a quarter from now on, that will probably their cash position's probably gonna last them for about 5.6 quarters. At the rate they're burning cash right now, they'll probably run out of it mid 2023, something like that. So I'd assume we'll see a capital raise sometime in 2022, probably second half. So that might give us another buy-in opportunity if the stock doesn't recover from this point. But as of right now, the company's sound. They've got loads of cash that will keep them going for quite a few quarters, so that's a good thing. There's some really good questions in the earnings presentations. So this guy asked them if the federal stimulus is gonna manifest itself in 2023, and basically he said that it's a complicated question, but not much of the money is going to flow through states, and the states have to design their programs. That's why we're estimating that we won't see much of that in 2022. We may see some in the back half of the year. It's hard to predict, but if we think about it, all these countries, whether it's the US or the EU, Chargepoint is in the EU as well, they will invest in infrastructure, and that will help Chargepoint and other EV charging companies. So this person asked them about the supply chains and their pricing, and then are you seeing the need to redesign products or particular subsystems in order to help the resiliency of the supply chain, and how active are you guys in passing on the additional costs to consumers? Basically, they've said that their team's been working really hard on this, and they've come up with upside. When you get obviously surprise decommit, which is happening everywhere in the industry, means that your organization is responding by rapid qualification of substitute components and rapid adjustment in software to enable that. So they are finding different parts and everything, which is really good and shows that the team's gonna do anything they really need to. So then over here they touch on pass-through pricing. I'm just going to read this. So without getting into specifics, we definitely have a program in place for passing through some level of our increased logistics fees. They don't go in what that is, but I'm going to assume it's something to do with the subscription fees, which is really good because you want a company that's able to increase their prices as cost of operations or inflation goes up. So this guy asked them about their supply chain issues again. He wants more details, and they actually provided that. So it's basically, the issue is them having to put parts, so hardware and stuff like that, on planes versus boats, because we all know that boat ports are just crammed with boats that can't even dock because it's so bad. But there have been news that situation is actually getting better, so maybe we'll do better in the future. Let's have a look at this question. Anyway, to help frame the amount of demand in the pipeline you guys weren't able to meet this quarter, I'm just going to read the answer because I think I don't really need to comment that much. So I would tell you that there was a positive spillover from Q3 to Q4. It wasn't massive. I hesitate to give you a number, but I would just tell you what's important is to understand that there was demand in the quarter that we didn't meet. It was a big enough number that warranted mentioning it, and it set us up for a nice start here in Q4, but it wasn't a massive number. That's not very exciting, but I'm really just going to assume that it's going to happen again and again and again as the quarters go. Because if we think about the future, 5 to 10 years from now, there's going to be way more EVs out there. Therefore, we'll need way more chargers. So as the industry grows, so will the need for charging stations. So there was another really good question that they asked about fleets. So Chargepoint's really going after fleets, and they want to be the market leader in that sector. So let's just have a read. You mentioned fleets coming at you from all directions, which is a good thing, of course. Or is something changing with fleet? Is there an uptick in just overall demand or a tipping point that we've hit, or are you taking more share? What do you think the evolution is here for fleet? And then obviously he answers, it's pretty basic. What I would love to say is, hey, we're talking. I mean, I think we are gaining share. Relative to a couple of years ago, no share to gain because there were limited vehicles. So if you think about a few years ago, there weren't that many EVs, and nowadays more and more companies are producing EV vehicles. And when there aren't vehicles shipping in volume for manufacturers and you're limited to pilot level program sizes, it just isn't that meaningful. So if you think about Rivian or NIO or even Tesla, Tesla's only ramped up their car manufacturing in the past 2 years, really. Obviously it's still gonna grow and everything, but they were all like small programs. Anyway, as we develop pilots and cement our relationship with our fleet customers, obviously based on earning that trust, as they expand, they will expand with us. So as these companies that manufacture EVs start partnering up with Chargepoint, and as they grow, let's say NIO, Rivian, Lucid, Xpeng start scaling and they're producing like millions of vehicles a year, then Chargepoint's earnings will go up accordingly, I think, in my opinion. So let's move on to price targets now. We can see that the stock's been beat down all the way down to $16, and the average analyst is projecting 28. That would be about a 75% increase, which isn't too bad. Before we cover the price targets, I just want to remind you that this isn't financial advice and this is just my research. Don't get too excited about these numbers down here. The stock's probably not going to go to 1.2k. Well, it might, you never know, but 2030 is just too far to estimate. So this over here is their shares outstanding. I've assumed that they're going to have to raise capital every year for the first 5 years. So I think they'll raise about 3%. That's why these numbers keep going up here and then they stop because they become profitable somewhere there, but it might happen sooner or later. So all of this data will change as time goes on. I've assumed growth rates of 70% for the next few years, and then they'll gradually go down. Obviously, it's hard to tell because by 2030, God knows what's going to happen. So fair value is at 30 times earnings. Even from here, so the stock's at 16, that's a 30% increase, which is pretty good. But then because we're in the EV market and EV car sales are going to pick up, I really think we'll be probably looking at euphoric values, and the average analyst target is somewhere in between. So maybe at about 40x revenue. When it comes to market leader valuations, so the stock's been at 55 with less revenue. So it's reasonable that as we go through euphoric and dysphoric cycles, we could probably see very high prices. So what I'll do, I'll probably be looking at trimming when we get to 50 times earnings and then taking profits properly over here and then trying to buy over here. But basically, I think one of the most realistic valuations are probably up to 2024, 2025, because it's just too difficult to predict what's going to happen so far in the future. In the meantime, I do think that these growth rates are going to persist, but obviously we'll see, time will tell. Let's do some TA now. So the yellow dotted line is the 50 weekly moving average. And then the green one's the 50 on the daily, and then the red one's the 200 MA. Right. Looks like we're going down. So we've got support there, and I don't want to crowd the chart by too much, but basically we had a floor here. We saw loads of dip buying coming in at about just under 20, but obviously that's now broken and it's turned into resistance. We've just rejected off of it, so it seems that we're now stuck just under here, and we're struggling with this. I think we've just rejected it today. Yeah, so if we got over the 200 and the 50, that would be really bullish. We'd actually like break this downtrend, because right now we're just going down. We have to stop going down before we can actually rally. So I wouldn't be surprised if we do keep going down, because the market's freaking out on inflation. Most growth stocks are getting beat down, so I wouldn't be surprised if we saw more downside. Now I'm not gonna I'm not gonna try to bottom tick all of these moves, but I wouldn't be surprised if we did lose all of the support and went down to 10, but obviously that would probably only happen if the market crashed or something like that. Now all of these moving averages, they will act as resistance, so we will have to get over them. Before I go in fully, I want to see us get over them, but it might just take some time, because as it is right now, we're just going down. How are we gonna go up if we can't stop going down? The only ways this could happen is if we just bounce back, or if we go sideways, so something like that, and then break the downtrend, and then we can resume back up. Plus these moving averages will probably catch up by then, but we'll see what happens. So to end this video, I really do like the stock. I think it's got tremendous potential, but obviously we'll see what happens. It's currently at $16. I have been buying the dip. I will buy more if it actually keeps dipping, because it's like 30% lower than my fair value. So yeah, that's quite a good deal in my opinion. If you like this video or found it helpful, I'd really appreciate it if you hit that like button. Let me know in the comments below, what are your price targets? Do you think Chargepoint's a good buy or not? Should we also just short the stock? Yeah, that's it. I'm just rambling about now. Anyway, have a good day. I'll see you soon.